Welcome. Good evening, students, to all of you who have logged in. So, students, today we shall be discussing about a new chapter, that is Audit of Banks, chapter number 12. So, students, 2 sessions have been allotted for this chapter. And you have to understand that this chapter is very, very wide, and the topic is also very, very wide. So at the intermediate level, you have to just gain a basic understanding of some things, of few concepts, and you have to develop an overall approach. Some concepts are presented in detail, but if you intend to become a master of bank audit just by reading this chapter, then do not try to do that. Okay. This chapter would also be there in your final exams. So you have to understand this chapter, keeping into account the limited syllabus of this chapter in your auditing subject. Okay, guys. So understand. So you are very well familiar with banks. You have gone to banks for deposit of cash. You routinely use ATMs for withdrawing of cash. You are making UPI systems. You are using debit cards, credit cards, and you are using also various mobile apps while doing banking activities. So students, first of all tell me that how do banks operate? By this I mean that what is the business model of banks? What is the business model of banks? I want to ask from you, what is the basic function of a bank? So what is the basic function of bank? How do the banks earn profits? What they are supposed to do, just in your own language, not by referring to modules, just from your own understanding, what you know from a common sense point of view. Yes, only Darshan has answered, and Singh Rajiv Kumar also. And what about others? Yes. So Darshan and Singh Rajiv Kumar, both of you are correct. The basic function of a bank is acceptance of deposits. Acceptance of deposits and lending of money. Okay, guys, am I clear? Are you clear, guys? So how do banks function? They accept money from public. And lend money. So in doing so, they are also doing many other things. They are also providing host of other services also. But as far as banking is concerned, this is the core of banking activity: accepting money and lending money, accepting money from public and lending money. So How do the banks earn profit? So guys, first of all, let me ask a question. When bank accepts money from you, okay, so you deposit, say you deposit 10,000 in your saving account, and say your saving as on 31st March is, say, rupees 1 lakh. So where would this saving balance would be, saving balance of rupees 1 lakh would be reflected in the financial statements of bank? On which side and under what head? Yes, tell me. You have deposited, say, 10,000 in your saving account, and say balance as on a date as on 31st March in your saving account is rupees 1 lakh. Cumulative balance. So tell me where this balance of rupees 1 lakh is going to be reflected in the balance sheet of a bank. Can you tell? Yes. Anybody? And my related second question is that suppose you have taken a car loan from a bank, then where it would be reflected in the balance sheet of a bank? Both things, tell me. Yes, students. Number one, where your saving balance would be reflected, and number two, where suppose you have taken a car loan, then in the balance sheet of bank, where car loan would be reflected. Yes. Yes, you are answering rightly, guys. Say saving account is the balance in your saving account is the liability of the bank. Bank has to give you back. Okay. And bank also pays interest to you on this balance. So these are reflected under the head deposits in the balance sheet of a bank. And the car loan which you have taken, it would be reflecting in the asset sides under the head advances. Because the bank has to recover money from you. The bank has lent you some money for purchasing a car. So it would be reflected under the head advances in the financial statements of a bank. Okay. So deposits are under liability and loans given by bank are under the head advances. Okay. Is that clear? So guys, you can, and how do bank earn profits? Say whatever the bank pays you on your deposit, the rate of interest is substantially lower. Okay, suppose you are getting 3% on your saving account, 3% per annum, or if you make a fixed deposit with bank, the rate of interest may be, say, 7%. But when you avail a car loan, so the bank may be charging, say, 10% or say 9% from you. So the difference, the spread is it is a spread from where bank meets its establishment expenses, staff cost, administrative expenses, and the balances profit of the bank. Broadly we can say, just a yardstick for simple understanding. Okay. So students, you now must have understood that advances constitute one of the major portion of assets of the bank. Substantial portion. Okay. So most of the funds of bank would be there in the substantial number of funds would be there in the form of advances. Okay. So besides all general things, we shall be first learning about advances. So I am not taking the same sequence which is in your module. We shall be first taking up advances. Okay. So advances constitute one of the most significant areas in the financial statements of a bank. Okay. So obviously the auditor has to be satisfied about all the management assertions regarding which the management is making regarding advances. Okay. And you have also to understand that there is an elaborate internal control system. There is an elaborate internal control system over advances in banks, because advances are one of the most significant activities undertaken by banks. So there is a robust internal control system. There are head office guidelines, there are regulatory guidelines, and there are internal systems, procedures. Okay. So now we try to understand this thing from a very simple point of view, from a common man's perspective. Say you go to bank for a loan. Okay. Say you want to avail a, say, car loan, or you want to avail a housing loan. Assume anything. So you go to a bank with a request to give you a loan. So is the bank ever ready to give you a loan? What procedures does a bank have? What inbuilt procedures, what inbuilt system does a bank have for considering your request? So when we talk about those systems, those procedures, we are talking about internal control over advances. Okay. So we are talking about internal control over advances in a bank. So what, just think over, guys, just think over with a cool mind. What could be the internal controls over advances in a bank? You have gone to bank for a loan, for sanction, with the request to sanction you a car loan, say of rupees 10 lakhs. So what could be the internal control of the bank before it over advances, or even to consider your request to grant you a loan? Can you think of any 1-2 points? Can you think of any 1-2 points? Yes, guys. Can you think of any 1-2 points, students? Yes, waiting for your mail, students. Yes, all of you are quite intelligent. They will, Darshan is saying they will require some sort of security. Yes. Collateral, they check our credit scores. Yes. Bhumika is saying repayment schedule. Aisha is saying credit worthiness, Kiran is saying payback capacity, and inquiry, Male is saying inquiry. Yes, you guys are on the right track. So basically, before considering your application for loan, the bank would check your credit worthiness. He would check, the bank would check, the concerned officer would check whether you are a credit worthy borrower. Okay. So this is an example of, say, we are taking a very simple example of an individual customer. But say when a company approaches a loan, who are its for a loan, who are its directors, what is their background, what is the net worth of the company, and what is the net worth of directors, okay, and what the security they are offering, and first of all, what is their nature of business, what they are going to do, from what business activity they would be undertaking, because it is only from the business activity that they would undertake that they would be in a position to repay the loan to the bank. Okay. So first thing is credit worthiness. Okay. So bank would see that they are lending to credit worthy people. Okay. And they make a elaborate credit appraisal. Appraisal, you understand? So we are students, we are talking this in very conversational manner, in a general way. Okay. So you know what is appraisal? Appraisal means to get apprised of something, कि किसी की चीज के बारे में समझना. अब credit appraisal means the bank makes a detailed assessment that suppose the company which has come for a loan, okay, what are its requirements, whether those requirements are justified or not, okay, what profits they are projecting, and whether they would be in a position to achieve those projections or not, whether they have got the wherewithal, whether the directors or the management they have some experience, they are experienced in that line of business activity. Okay. So how they make a detailed credit appraisal. They also go through all the past year's financial statements and the projections submitted by the company. Okay. And on the basis of that, they arrive that whether the credit facilities which are sought by the bank are in fact reasonable, whether these are inflated. Okay. Say you say company wants to purchase certain machine of for setting up certain project, and say the actual cost of the machine is 50 lakhs, but the company is submitting a quotation for rupees 1 crore. Okay. So whether the cost has been deliberately inflated, whether it is in tune with the actual market costs. Okay. So 5-10% variation can be there. Some machine may be having some sort of features, additional features. Okay. So after doing all this exercise, after making a credit appraisal, the bank sanctions the loan. So sanction in case of bank is not a verbal commitment. It is done by means of a proper sanction letter given in writing. proper sanction letter given in writing. Okay, say if a car loan has been sanctioned to you, then there would be letter saying that we have sanctioned the car loan of rupees 10 lakhs and the installments are so much, you have to pay in a span of 3 years or 5 years, whatever it is, and this is the EMI amount. So after the loan is sanctioned, the documents are executed. Legal documents are executed on stamp paper. Which show that that indeed you have taken a loan from the bank. So these documents are different for different kind of loans and vary from bank to bank. Okay, so there are documents to be adhered to by the branches of banks, which are advised by them from their head office, and accordingly documentation is made showing that say one branch, that a branch has granted loan to a customer. Okay, and similarly, say in case of a company goes for seeking, say, loan for purchase of machinery, then bank would also be requiring some extra security. Say the bank may be asking for mortgage of some residential property or some land or some building, etc. Okay, so and not only that, they would be requiring original title deed of that asset, but it would be also appropriately mortgaged with the bank. It would be done by legal process, where the property is mortgaged to the bank legally. Okay, so this is all part of documentation. Okay, so you can understand that there are many steps involved. So first part was fact checking about the customer, and it is included in credit appraisal. Okay, then comes sanction part, then come documentation part. Once documentation is complete, then credit facilities, loans are released. Say when you have signed the documents in a bank, the bank say for the purchase of a car, you have signed the documents, the bank would transfer the money to the dealer from whom you are going to purchase a car. Okay, so after the loan has been released, now comes the another important part, that is credit monitoring. Darshan, I have already told you about sanction letter. Basically, it contains terms and conditions of the sanctions. Okay, what they have sanctioned and what are the terms. Say while say that a bank has given you a car loan, or a bank has given some credit facilities to a company, so it would be stated that what conditions are to be complied with by the borrower before the release of facilities, and also during the facilities. Say bank levies certain charges, processing charges, etc. So that would be written. Okay, and many other things pertaining to financial discipline, maintenance of financial discipline, that would be written. That say the company would be providing financial statements. Okay, there would also be mentioned about rate of interest, that what rate of interest would be charged. And similarly, there are a lot of other conditions. It could run into many pages. Such conditions may be about 60, 70 or 100 in number. Okay. So when documents have been executed, documentation part is complete, facilities are released, loans are released, then comes another important part, that is about credit monitoring. That is about credit monitoring. Okay, so what is credit monitoring? जो क्रेडिट दिया है बैंक ने उसको मॉनिटर करना है. So whether the party is repaying as per terms and condition of sanction letter, okay, or these kind of things, whether in case of a company, whether where the bank has granted some credit facilities, whether the unit is functioning, whether the bank officials also make surprise visits to the premises of the company, okay, to see that the company is having adequate stocks. Okay, so such kind of things, all these things fall in the broad range of credit monitoring. Okay, so at the beginning I had told you that this is a very, very, very vast topic, and at the intermediate level you have to understand only certain basic things. You can't become a master of bank audit by reading these 30-40 pages. This you understand, and within this limited context you have to understand this chapter. Okay. Yes, there are many remedies available to bank. The bank has Himanshu, the bank has bank can levy penal charges, or even it can recall the loan. It may ask the company to recall the loan. It has power to take possession of the asset also. Okay. So now let us try to go into your module. So we are, guys, at page 12.36 of your module, 12.34 to be precise. 12.34 of your module, point number 14, audit of advances. Okay. So now I have given you a background in general terms. So now it would be easier for you to understand. So advances generally constitute major part of the assets of the bank. Okay. There are a large number of borrowers to whom variety of advances are granted. So in carrying out audit of advances, auditor is concerned about these things, that amounts included in balance sheet in respect of advances which are outstanding at the date of balance sheet. Okay. Yes, Darshan, yes. Advances represent amount due to the bank. Obviously, only those things should come in under the head advances which represent the amounts due to the bank by the customers. Okay. Amounts due to the bank are appropriately supported by loan documents. It is only when the bank has got legally enforceable loan documents with them, they have a right to demand money from you. Okay, because if say some borrower has defaulted, then bank should have those legal documents to show that borrower was in fact sanctioned and he had availed that credit facility. Okay. There are no unrecorded advances. So all advances have been accounted for. There is nothing in the books of accounts which is of a bank which is in the nature of advances, but it has not been recorded. The basis of valuation of advances is appropriate. So what advances have been valued properly in accordance with the head office norms and in accordance with the regulatory guidelines. And advances are disclosed, classified in accordance with the statutory and the regulatory requirements. So guys, here I would be touching little bit about classification of advances. Okay, we'll be just in a short while, we will be discussing about it in greater detail. So you have to understand, students, that there are regulatory. Who is the regulator for banks? Tell me. Who is the regulator for banks? Which institution regulates banking industry? Tell me. Which is regulator for banks? Yes, tell me, guys. Which is regulator for banks? Yes. Himanshu, RBI. Yes, everybody is writing RBI. Great. So Reserve Bank of India is regulator for banking industry. So there are comprehensive, elaborate norms by the RBI as to how advances have to be classified. Okay, so guys, you have read about NPAs. Have you heard the term non-performing assets? Non-performing assets. Have you heard the term? Anybody who is well conversant with banking, or who is tracking social media or reading newspapers or even listening to news, then you must have heard about the term NPAs. So NPAs, by NPAs mean non-performing assets. So broadly, you can understand where the parties are not repaying. We shall be just discussing about that, but at this stage, you can get a broad hint that where recovery is not forthcoming as per regulatory norms, as per norms prescribed by RBI. Okay, so when according to norms, these advances do not generate income for bank, so they become non-performing. So when bank has lent money, when bank has given advance, they would be basic objective of the bank is to earn interest income from those advances, isn't it? They want to earn interest. Say if the party is not servicing interest or the party is not repaying installments, so these assets, these advances cease to generate income for bank, and they are classified as non-performing assets. They are classified as non-performing assets. Okay. So we shall be coming to non-performing assets within 10-15 minutes. So for the time being, you can understand this. So the auditor can obtain sufficient appropriate audit evidence by study and evaluation of internal control. So what is the internal control of the bank? That examining the validity of recorded amounts, examining loan documentation. Like I have told you that every loan granted is to be backed by valid legally enforceable valid documents. So it becomes important on the part of auditor to examine loan documents. Okay, so that he knows that the internal control over advances is satisfactory. Reviewing the operation of the accounts. Okay, whether the account is working properly or not, transactions are happening or not. Examining existence, enforceability, and valuation of security. Whatever security, say some property has been kept by a borrower for availing a loan. Okay, whether a legal opinion has been obtained, whether all the original documents have been kept with bank, whether legal opinion states categorically that title of the borrower is clear. Okay, and checking compliance with all appropriate classification norms, which I was telling you, hinting about right now, relating to NPAs, and carrying out appropriate analytical procedures. Okay, so what are the how the auditor can we have seen how the auditor can evaluate internal control. So in general, internal control over advances should include the following. Now these things I have already made you learn generally. Okay, so these are the internal control over advances, which are these, some of these or all of these are followed by banks in relation to advances. Like the bank should make an advance only after satisfying as to credit worthiness of borrowers and obtaining sanction from appropriate authorities of the bank. Okay, it is not that, say, if you go to a branch, that bank manager has branch manager has all the power. No, in the banks there is a proper system. There is delegation of authority. Say the branch manager, which is sitting in the branch where you go for with the request for loan, he may have got a power of, say, rupees 1 crore. Okay, so beyond that, the power might vest with their regional office. Okay, or with their zonal office if loan amount is greater, or with their head office, with the CMD. Okay, or with some committee there in the head office. Number 2, all the necessary documents should be executed by the parties. So this is again relating to documentation. You understand. The compliance with terms and of sanction and use of funds should be ensured. Now, say you have gone to a branch for a car loan. So obviously, when the money has been paid to the dealer by the bank and loan has been given to you, obviously the bank would want that there is some document in the file to show that use of funds was for the purchase of car. So they would be wanting a copy of invoice from you. So these kind of things. So sufficient margin is, as specified in the sanction letter, should be kept against the securities taken. Okay, so what is margin? Yes, students, do you know about what is margin? In case of banking, what is margin generally? Say you go to a bank for a car loan and assume that cost of car is rupees 12 lakhs, and assume that cost of car is rupees 12 lakhs. But now the bank says that we will finance you only rupees 10 lakhs. So what is 2 lakhs? 2 lakhs is your own margin. 2 lakhs is your own margin. Okay, so margin means basically the own funds of the borrower. So in this simple example, this 2 lakh money would be brought by you as your own contribution. So what is the purpose of this margin? What is the purpose of this margin? To the margin ensures, the bringing of margin ensures that the borrower has stake in that asset, or it has a stake in those credit facilities. So it is not that bank would finance 100%. Okay, they generally say bring some margin. Okay, but nowadays some private banks, in case of cars, etc., in case of small loans, they are financing even the whole cost of assets, but generally they insist for margins. It may range from 10% to 25% or even more. Okay. And in case of credit facilities granted to business, the margin is usually 25%. Okay, so say a company goes to a bank for say acquisition of machinery of say 1 crore. So the bank would say bring 25 lakh as your on capital, 25% margin, and 75 lakhs will be financing you. Okay. If securities have been taken, the ownership should be transferred in name of bank. All securities requiring registration should be registered. So like these are related to mortgage, which we will be studying after a short while. Okay, so these kind of things. Drawing power we shall also be studying right now. So the operation of each advance should be reviewed. This is also part of credit monitoring. When loan has been granted, so the bank would see whether the loan account is operating properly or not. This is known in banking language as credit monitoring. This is credit monitoring. Once you have granted the loan, now whether the repayments are coming, whether the borrower is complying with all the terms and conditions, okay, whether the borrower is servicing interest on due dates. So all these things are monitored. Okay. So these are only few points. So students, you can understand that in complex business environments, in bigger loans, how complicated it could be. Okay. There are a lot of internal control requirements in banks pertaining to advances. It is just a small minuscule framework which has been given to you for your understanding. Okay. So clear? Clear, students? Internal control over advances. Now we shall be taking up first few terms connected with advances. Few terms connected with advances before we come to topic of NPAs. Few terms connected with advances. So students, when bank gives credit facility, these are of two types. These are of two types. One is funded facility and another is non-funded facility. Do you have any idea of what is funded facility and what is non-funded facility? Idea? Any guys, have you any idea? What is a funded facility and what is a non-funded credit facilities? Any intelligent guesses? Yes, any intelligent guesses? Yes, guys, have you any idea? No response. So I assume that you do not have any idea. So funded facilities are, say, where the bank has actually transferred money. You can understand it in this way generally, actually transferred money or funds. Like, say, when you avail a housing loan, the bank is actually transferring funds. It is making payments on your behalf to the various contractors, to the material suppliers, or it is transferring some amount in your saving account also. So where the bank is actually transferring the funds, these are known as funded facilities. Or say you have got a car loan, it is an example of funded facility because the money has actually been transferred. Okay. Or say when you take an education loan, so the loan has been taken to pay the fees of a college. Okay, so the money has actually transferred from bank to the college. So this is also an example of funded facility. So similarly, say a company has purchased a loan for construction of building. It is again an example of funded facility. So these are examples of funded facilities. And what are non-funded facilities? Non-funded facilities is where there is no transfer of funds at this stage. But in future, there could be possibility that a liability may devolve upon the bank. Okay. So therefore, it is a non-funded facility. Now, what is the example of it? Say, guarantee issued by a bank. Say you are a company, okay, you are going to purchase machinery. And assume you are importing it from another country. You are importing it. And now the duty which is required to be paid at the port, now it can be waived off under the rules framed by DGFT under the foreign trade policy, subject to certain conditions. Okay, so some sort of, say, license is to be issued, and for issuance of this license, the custom authorities want you to give a bank guarantee from bank of certain amount. So basically, the custom authorities want want the company to ensure that if the company does not meet its commitments as required under the foreign trade policy for grant of a license, then the custom authorities can invoke this guarantee from bank, which a sovereign bank has given. So if the company doesn't doesn't honor its commitment, then the bank would encash this guarantee. The bank would invoke this guarantee from the branch of the bank which has issued it. Okay, so these type of facilities are non-funded credit facilities. These are sort of non-funded credit facilities. Clear, students? Okay, so another example of non-funded credit facilities, just like letter of credits, LCs. Letter of credits. Now, what are letter of credits? Now, say I am an importer based in India. I am importing certain raw materials from another country. Say I am importing certain raw material from say South Korea. Then the suppliers from whom I am procuring these raw materials. He asked me, that company asked me to get a letter of credit, LC, issued in the favor of that South Korean company. So when LC is issued by a bank in the favor of South Korean company, then that South Korean company is assured that when the Indian company would be sending that South Korean based company would be assured of the payment. Okay. And because they, both of them earlier, they are not known to each other, and they do not have trust. Both are new to each other. So the other party wants to be assured that there would not be a financial loss to him. So they would be insisting upon LCs. Okay. So when a bank issues LC, then there is a possibility that at some future date, the concerned letter of credit might devolve upon the bank. That the importing party may not be able to honor its commitment. It may default, and then the liability would fall upon the bank. Say I am an importer, I am purchasing something, so I have to pay that from my funds. But I have also got issued LC in favor of another company, which gives a sort of guarantee, assurance to that company that his payment is secure. Okay, that when he would be sending goods to India, his payment is secured, because an Indian bank, a prime bank, a bank of sound financial position, it has issued a LC. Okay. So Aisha, do not just jump to these are very complicated things. These are not as simple. So the case you are referring to pertain to LCs, but it related to issues of LCs. That how LCs were issued in a fraudulent manner with some officers of bank colluding with the borrower. So here it was not that process, it was the manner of issuing LCs. The LCs were issued fraudulently. The competent authority had not sanctioned issues of so much LCs to that borrower. Okay, but these were arranged to be issued outside the system, and these were not put into the software of the bank due to certain technical issues. Okay, so this fraud occurred that way. Okay. So clear, guys? You understand? And now within funded facility, I would also like to explain 2-3 terms. Number one is term loan. Number two is cash credit, overdraft. And number three is bills purchased and discounted. Okay. So what is a term loan? Do you know difference between these terms, guys? Have you heard about these terms? Do you know the difference between these terms? Term loan, cash credit, overdraft, and bills purchased and discounted. So what is a term loan? What is a term loan? Term loan is generally for the acquisition of some asset. Say you want to purchase a car, so it is an example of term loan. So a company wants to purchase machinery and bank has sanctioned machinery loan, say repayable in 5 years. It is again example of term loan. Loan taken for the construction of building, it is again an example of term loan. Okay. So these loans are normally repayable after a certain period, like say normally 3 years or more than 36 months. And what are cash credits? What are cash credits and overdrafts? Now this is one more important term which would be coming again and again, which is in your module again and again. So you should be very clear about this term, cash credit and overdrafts. These two terms are used interchangeably. Okay. Cash credit, overdraft, demand loans, even sometimes it is also said demand loans, but generally the term used is cash credits or overdrafts, and most of the time the term used is cash credit. So we shall be using the term cash credit only. So now what is a cash credit facility? Now what is a cash credit facility? Students, you know that that a business cannot run without working capital funds. You know about working capital cycle. So working capital is required because an organization, a concern, a company is regularly incurring day-to-day business expenses. Like say in case of a manufacturing company, in case of a manufacturing entity, raw materials are going to be purchased. Okay, then production expenses would be incurred. Obviously, like power, fuel, wages, these are going to be incurred. Then finished goods would be produced. They would also take time, storage time. These might not be sold as they are produced. Okay, so these would be sold, and then there would be also a credit period. The customer would pay after some time. Okay, so only then cash would be realized. So this is a sort of working capital cycle. So every company, every business needs to fund its working capital requirements. It needs funds to meet its working capital requirements. Without that, the company cannot function, because there is always a gap between the time the company is incurring the expenses and the time when realizations would be made. Okay, so this cycle is inbuilt. It is in every business. Every businessman knows this, whether he is a small shopkeeper or whether he is running a small company, or whether he is running big company, or whether it is an MNC. Every company knows this, that there is a working capital cycle and its working capital requirements have to be funded. Okay, now as you know, businesses are always short of funds, so they go to bank for meeting their working capital requirements. Okay, so what the bank does is, bank grants them a cash credit facility, which is in the nature of working capital facility. Bank grants them a cash credit facility. Say I am a company. I have a company manufacturing in something, say in manufacturing of anything, in manufacturing of fabrics, say, and the company wants working capital requirements of, say, rupees 1 crore. Okay, so first of all, the bank would make all kinds of due diligence and credit appraisal, and they would sanction me if they found my request to be genuine based upon assessment made by them. They would say, sanction me a cash credit facility of rupees 1 crore. Now, how this thing operates? They would not be immediately transferring to the account of company rupees 1 crore. No, it is not like that. Cash credit facility does not operate like this. What they have done is, they have sanctioned me a facility of rupees 1 crore, say, in the books of bank. In the books of bank, account would run like this. In books of bank, account of company X would run like this. Okay. Say the bank has sanctioned the company credit facility of 1 crore. Now, the company has got power to use rupees 1 crore. Say now the company wants to purchase raw material. It has issued a check of 25 lakh. That 25 lakh check would get debited in the account because it is an advance account and it is credit facility has been sanctioned, and there would be debit balance in the books of bank, 25 lakh, showing that bank has granted an advance of 25 lakhs to me. Okay. Yes, it is used for short-term funds. It is known as short-term credit facility. Basically, why it is known as short-term, Darshan? Because it is renewed, it is assessed every year. It is for 12 months. It is a continuing facility, but it is assessed after every 12 months. That is why it is known as short-term. And working capital funds, by its very nature, are short-term. You know that operating cycle, a company is expected to complete its operating cycle normally in a period of 12 months. From the time they are procuring raw material to the final realization from debtors. Okay. So say they have issued a check of 25 lakhs in favor of raw material. Say another 5 lakhs they have withdrawn for payment of wages. So now the balance in the account would be 30 lakhs. I am talking about the account of company in the books of bank. In the books of bank. Okay. Say after, say, 10 days, they purchase another lot of raw material of rupees 10 lakhs. So now the balance would be 40 lakhs. So they are incurring again some office expenses, paying salary to staff, or say machinery repair expenses of 5 lakhs. So the balance would now be 45 lakh. Meanwhile, goods have been sold and some payments come. When the payments come, the account will be credited. Say then the payment of 10 lakhs has come. So the amount, now the balance would be reduced to 35 lakhs. And so in this way, the account goes on. When the payment comes, the balance is reduced. And when the expenses are incurred for business purposes, the facilities are utilized. And the rate of interest, the interest is charged only on the amount used. So the rate of interest would not be directly on 1 crore, but what the borrower is using. For how many days he is using 25 lakh, how many days he is using 5 lakhs. So rate of interest is also fed on these parameters in the system. Okay. So clear, you get a basic understanding of what do you mean by cash credit facility. Yes, students, any doubt? So I am just emphasizing about fundamentals. Okay. Yes, students. Yes, guys, tell me, you have understood what is the basic meaning of cash credit facility? How does a cash credit account operate? No, it is not so. It is not so, Darshan. So you are saying clear. So another term we had used in funded facility was bills purchased and discounted. Okay, this facility is also for meeting working capital requirements. This facility is also for meeting working capital requirements. Now, what is bill purchased and discounted? Now, let us take an example. Say, students, I am an exporter based in India. And I am exporting, say, ready-made garments. Like t-shirts. Say I am exporting t-shirts to a US-based company. So I have, say, sent a shipment of $10,000. Okay. And my credit terms with this US-based company is, say, 60 days. Now I have exported the goods, I have sent the shipment, I have got all documents with me, shipping bill, documents showing that goods were exported. Okay. So, but payment would be coming after 60 days. So now my funds are stuck for 60 days. It is going to take time. Meanwhile, I want funds for a quicker moving of my working capital cycle. So what I do is I go to the bank and I get purchased this bill. Okay, say of US dollar rate is 82, 8,20,000. I get purchase this bill. So bank would deduct its interest for 2 months and other charges, applicable charges, and balance amounts would be given. So this is an example of bills purchased and discounted, where bills are purchased and discounted. Okay, so it is also a funded facility, and it is also meant for meeting working capital requirements of a borrower. Clear, students? Now you are asking, Dikshita is asking, interest on overdraft of full sanctioned amount. What you are asking, Dikshita? I think you are saying that whether interest is levied on sanctioned amount or utilized amount. Is this you are asking, Dikshita? Obviously, interest on cash credits, interest in cash credit accounts is levied on utilized amounts. Levied on utilized amounts, not on sanctioned amounts. Because say if 1 CR is sanctioned to a company, it might be possible that that company has not used that amount fully. So interest would be leviable in which is in commensurate, which is commensurate with his level of, with company's level of utilization. Okay. Yes, Sudhanshu, it's true. And Darshan, what you are asking? Yes, after discounting charges, you are saying. Okay. So you are clear about? No, Dikshita, overdraft and cash credit are one and the same thing. Sanctioned, when we say that cash credit limit has been sanctioned, cash credit limit sanctioned, it is of say 1 crore. Okay, or we say overdraft limit sanctioned of say 1 crore. Both of these mean same thing. These denote same thing. And if I say cash credit limit was partially utilized or overdraft limit was partially utilized, it means same thing. Yes, Aisha, it is not meant to be fully paid. Cash credit limit is not meant to be fully paid. Its balance changes. Sometimes say when the payments are more, the balance will come down. Say it might come to zero, or it might come in credit, or it might comes to a nominal amount, say 10 lakh, 15 lakhs of a 1 crore limit. But when utilization is high, when payments are, when production is in full swing and the payments are yet to come, then utilization level might touch say 80 lakhs, 90 lakhs or complete 1 crore. Okay. So, but the assessment of these limits is always renewed generally after 12 months to assess whether the parties, whether the borrower is properly utilizing these, or whether the limits utilized are sufficient, whether borrower is operating account satisfactorily, or whether these credit facility need to be reduced, or if there is a request from borrower that his working capital needs have increased, whether, and there is a proposal for it, there is a request for it to sanction enhanced working capital limits, then whether these need to be considered. Okay. Bill purchase, Bhumika, I have already explained. So you can rewind the video. If I explain it again, then many things would be left. Anyway, we will be, when we will be coming to module, part of it, we can touch it there. So clear, students? And now we come to other terms associated with advances. These terms are, one term is primary security. And another term is collateral security. No, Aisha. The company won't have a separate current account for availing cash credit facility. Cash credit facility is itself in nature of an operative account. All the checks are passed, all the payments are being made through the cash credit account. Okay. So what is the meaning of primary security and collateral security? Yes, anybody? I think Darshan was writing about it. What is primary security and what is collateral security? Do you know? Yes, students. Anybody? What is primary security and what is collateral security? Yes, students. Anyone? None. So primary security, students, you have to understand that primary security is security which is offered by the bank, against which money has been lent by the bank, against which finance has been extended by the bank. Like, say you went to bank for a car loan. So the bank is financing to you against your car. So what is the car? Car is primary security. Primary means basic, जिसके against finance दिया गया है. Okay. So take another example. So see, there is a company. It has gone to bank for sanction of a cash credit facility. CC, cash credit facility. Okay. Say rupees 1 crore. The bank has sanctioned the cash credit facility. The bank has sanctioned the cash credit facility. Now, what the cash credit facility is against? Cash credit facility is basically for what? What is the purpose of cash credit facility? Tell me. What we have understood right now, by understanding meaning of cash credit facility, what is bank financing by granting cash credit facility to a company? Yes, current assets. Dikshita, you are right. So bank is financing current assets. Like, so what are the main current assets? Inventories or book debts, debtors. These are two main current assets which the bank is financing. Yes, it is for meeting working capital requirements, but my specific question was what the bank is financing for by sanctioning cash credit facility to a company. So the bank is financing current assets. So what the bank is financing? Current assets, which mainly comprise of inventories and book debts. And in most cases, in many cases, it comprises inventories only. Okay. So students, these would be primary security. These would be primary security in sanction of a cash credit facility. And say the bank had also mortgaged residential house of the director of the company while sanctioning this cash credit facility. Also assume that the bank had also mortgaged the residential house of the director of the company for sanctioning this cash credit facility. Now, what this security, the residential house which has been mortgaged with the bank, the original papers, the original title deeds of which have been mortgaged with the bank, have been deposited with the bank. Okay. So this security is known as collateral security. It means additional security. So what is the purpose of this additional security? The purpose of this additional security is to give comfort to the bank. So bank, normally when bank lends to business, when bank lends to industry, when bank lends to trade, it insists on collateral security. Give us land of so much value, give us mortgage with us your house, mortgage with us any other say apartment or a flat or these kind of things. So these are collateral securities. So you understand, guys? Is that clear? Difference between basic difference funda between primary security and collateral security. Primary security means the security against which finance has been made by the bank, and collateral security is additional security. Clear to you guys? And now we come to modes for creation of security. Modes for creation of security. Now, say the bank has sanctioned cash credit facility to a company of say rupees 1 crore. So the bank has now the bank would ask the company to execute legal documents with it. So by this, the bank creates its interest in the security, legal interest in the security. Okay, so there are various legal terms associated with it, with the creation of security. So we shall quickly go through these legal terms. So one term is mortgage. Okay, another term is pledge. Okay, and another term is hypothecation. Another terms are assignment, set off, lien. So these are the general terms. So we shall be quickly going through these terms. You have to understand these are the basically legal terms by which banks' interest in the securities are created. These are modes of creation of security. There are difference between these modes by which the banks are creating interest in different securities. Hence, different names have been given to these terms. These are basically legal terms. Okay. So first of all, let us take hypothecation. So what is hypothecation? So this, when say a bank has granted cash credit facility, so it would enter into a hypothecation agreement with the company. So what does hypothecation mean? Hypothecation means that ownership and possession of security remains with the borrower. But bank gets a general charge. Say the bank has granted a say cash credit facility against security of current assets, against security of stocks. So obviously, logically you can very well understand, students, that stock would remain with the company. The company would remain the owner of goods. So the ownership and possession both would remain with the borrower. Isn't it quite logical? कंपनी का स्टॉक तो कंपनी की फैक्ट्री में रहेगा ना, उसके प्लांट में रहेगा, बैंक में थोड़ा रहेगा. So the bank just gets a right by executing this agreement. The banks get a right, a sort of charge over these current assets. So these are normally, such type of agreements are called as hypothecation agreements, and this method of creation of security is known as hypothecation. Okay, clear? So for granting working capital credit facilities like cash credits, overdraft, this kind of agreement is used. You have to understand this much. Okay, do not go too deep into it. Just understand this much. This is sufficient. And next we come to mortgage. Mortgage, you already know this term is used generally also. Mortgaging, like we say that, say like if a country has taken loan from another country, so people might allege that you have mortgaged our future. So now you understand, mortgage means किसी के पास रहन रखना, mortgage. Okay, yes, movable properties. Yes, Darshan, it's true. So mortgage is of two types. One is equitable mortgage and one is registered mortgage. Okay, so what is equitable mortgage and what is registered mortgage? Now, equitable mortgage means that the owner of the property who is going to the owner of the asset who is going to mortgage his, say, house or land with the bank, he goes to the bank, deposits the original title deeds there, and creates an equitable mortgage in favor of the bank by signing certain documents. Okay, here also the ownership, the possession of the property remains with the borrower, with the customer. But when a property is mortgaged, okay, it cannot be sold. It cannot be sold because original papers are lying with bank. How you, and bank would be having a charge. So unless you clear the liabilities, the property can't be sold. Okay, although property remains in the name of the on the borrower or the person who is creating the security, it the bank has got a charge on it. So you cannot sell it unless you clear that charge first. Okay. And what is registered mortgage? So you have to understand this much, that in registered mortgage, the agreement is duly registered. It is not only executed on stamp papers, it is registered by going to say Tehsil office, and it is registered there by paying appropriate stamp duty. Okay, so generally registered mortgage is done in case of agricultural lands where lands are held on the basis of ownership documents like Jamabandis, etc., prevalent by different names in different parts of the country. Okay. So this is the difference between equitable mortgage and registered mortgage. Now we come to pledge. Now, what is pledge? In pledge, the possession of goods can go with the bank. Say, when gold loan is taken, so gold ornaments are pledged with the bank. Okay, the possession goes with the bank. You deposit the ornaments with the bank. It is not that that the possession of the ornaments remains with you and you take the gold loan. Okay. Similarly, pledge may be used in case of working capital facilities also, but it is generally not so common where say banks also take charge of the godown where stocks are being kept, and all the goods are moved in accordance with some system agreed to between the borrower and bank. Okay, so this is an example of pledge. And there is another term, that is assignment. Assignment is, say, generally used in case of transferring some interest in some debt. Okay, like say if I got a life insurance policy in my name from a company, I have got life insurance policy. So I want to keep this life insurance policy as a security in bank. Okay, for availing certain loan. So because say life insurance policy was for 20 years and I have already paid premium for 15 years. So it has got certain value. So how the bank would be creating interest in this? This would be assigned in favor of the bank. This would be assigned in favor of the bank. So document would be created that this policy is assigned in favor of banks. Such type of creation of security interest in the security is known as assignment. Okay. And then there is term lien. Lien is, again, you have already read might be reading in Companies Act. It's a sort of general charge. It is when you have lien over something, you mean you have a general charge or right over something. So this term is used generally in this context. And another term is set off. Set off means that, say, when the borrower has taken a facility and there is a debit balance in his account in the bank and some balance, credit balance is lying in another account of the borrower in the same bank. Okay, so the bank has a right to set off that debit balance with that credit balance. This is known as set off. So these are the students modes of creation of security by banks. Okay. So now many of you are getting impatient. Manisha is also seeking a desperate break. So let us take a break for 10 minutes, guys. See you after 10 minutes. Yes. Yes, guys, welcome back. So, students, there is another concept of another term of drawing power. Drawing power, which is in short is referred to as DP, and this term is used in the context of cash credit accounts normally. In the context of cash credit accounts, in the context of CC accounts. Now, what is drawing power? So, drawing power, students, you have to understand it is the limit, it is the amount up to which funds can be used from a cash credit account. Okay. Say we take it, we'll try to understand it by the means of an example so that it becomes clear to you. Say a borrower has been sanctioned a cash credit limit of cash credit facility of say rupees 100 lakhs or 1 crore. Okay. So this is the sanctioned cash credit facility. Now this amount is sanctioned to the company, to the borrower. But the sanction letter also stipulates that borrower shall submit monthly stock statement. Monthly stock statement. Arriving at calculation of DP, that is drawing power. So every month, after the end of every month, the borrower company has to submit to the banks, say, a stock statement showing the position of stocks as on the end of the month. Assume that stock statement is to be submitted, say, within 4 or 5 days of the coming month. Okay. So, how DP is going to be arrived at? It would be arrived at by arriving at value of security, value of primary security, less margin. Okay. So, this is known as drawing power. So, how it is arrived at? Say the cash credit facility was given to a company against hypothecation of stocks only, and value of stocks, say on 31st December, is rupees 2 crore. Assume it is 2 crore. Okay. And what are the creditors as on 31st December? Creditors means because this stock has been purchased from creditors which are still outstanding. So these are already financed by creditors. So banks finance on the unpaid stocks, the value of the stocks which is unpaid. Okay. So less my trade creditors as on date are say rupees 1 crore. So value of what is value of paid stocks? Sorry, the banks finance only on the paid stocks, not on unpaid stocks. I by slip of tongue, I made that mistake. So value of paid stock is 1 crore and less margin. Say the margin stipulated was 25% in sanction letter. Say 0.25 crores. So the drawing power comes to 0.75 crore. It means 75 lakhs. So here, although the sanction limit of the borrower is 1 crore, but since on the basis of stock statements, on the basis of monthly stock statements which were required to be given by the borrower to the bank, in terms of the stipulations contained in the sanction letter, drawing power for that month at the end of the month is 75 lakhs only. So the borrower could be withdrawing maximum up to 75 lakhs, not up to 100 lakhs in this case. If we submit, say, if the company submits, say, this stock statement. Okay, so drawing power can be different from the sanction limit. Yes, Darshan, DP can exceed the sanction limit. Yes, DP can exceed the sanction limit, but what would happen in that case? The bank, there would be no effect on the cash credit limit, because bank is already the party is having more paid stocks. Okay, but the maximum the party can withdraw would be the sanction limit. Because this is a threshold, na, the borrower cannot withdraw from what has been sanctioned by the bank. Okay, is it clear? So again, Darshan, I'll make it clear for you. We take an example of where DP exceeds the sanction limit. So say I take the same example. Sanction limit of the company is rupees 1 crore and stock statement submitted is, as per stock statement for a month, value of stocks is as on date is, say, 3 crore. And say creditors are 1 CR. So paid stock is 2 crore. Okay. So paid stock is 2 crore. Less margin 25%, say 50 lakhs. So drawing power would be 1.50 crore. So sanction limit is 1 crore. Drawing power is 1.5 crore. So party can utilize sanction limit because it cannot go beyond 1 crore, which is the sanctioned amount. So Darshan, is it clear to you? Yes, Darshan, is it clear to you? Yes, Darshan, tell me, is it clear to you? Yes. So what is the relevance of this DP for an auditor? For in cash credit accounts, because while the norms relating to NPAs in relation to cash credit accounts use this term drawing power. We'll see how when we will be discussing about about NPAs. And the auditor concern is that the cash credit account remains within the drawing power. Okay, say if on a date the drawing power is 75 lakhs, then section limit is 1 crore. It is not that the borrower is using the cash credit limit beyond 75 lakhs. Okay, because he doesn't have necessary adequate drawing power to back those credit facilities. So this is its relevance, and this is why its correct computation has to be ensured. So how it practically operates, that the parties, the companies, the borrowers, they are submitting monthly or quarterly whatever stipulation is there, stock statements to the banks, and the banks, on the basis of DP arrived in those stock statements, they feed this drawing power in their system. So when the system is live, it shows when the account of that party is opened, it shows that sanction limit is so much, drawing power is so much. Okay, so obviously they would be letting the borrower to use the facility only up till drawing power amount. Okay, this is its relevance. Okay, and say it is not that for 1 month DP has reduced, then it cannot increase in next month. It can increase, say if next month the creditors are paid or the company purchases more stocks, then accordingly stock statements can be given, and DP would be arrived, and then bank would be changing drawing power in their system by after 1 month they might change it to 85 lakhs or 1 year. Okay, clear, students? Drawing power, what we mean by drawing power in the context of cash credit accounts is clear to you, students? Now we come to very important topic of non-performing assets. NPAs. Okay, so I have told you in the beginning that loans granted by the bank, that loans advanced by the bank are reflected in the balance sheet, in the financial statement of banks as advances. Okay, so advances can be of 2 types. These can be performing or non-performing. So what are performing advances? Performing advances are those, performing assets are those which generate income for the bank. Okay, and non-performing are those which cease to generate income from the bank. Which cease to generate, which do not generate income for the bank. So these are called non-performing NPAs. Bhumika, what you are trying to ask? You are saying, yes, a company can withdraw up to drawing power. If sanction limit is more, but drawing power is less, then company can withdraw only up to drawing power. Say, but if the drawing power is equal to sanction limit, then company can draw up to sanction limit. If the drawing power is more than sanction limit, then only company can withdraw up to sanction limit, because the company cannot go beyond sanction limit. Okay. Okay, guys. So performing and non-performing. So there are regulatory guidelines. There are RBI guidelines in this regard. So three terms you can understand in relation to RBI norms. What are these three terms? These three terms are income recognition, asset classification, and provisioning. So these are mandatory guidelines. Every bank has to follow these guidelines, has to follow regulator guidelines. So what is asset classification? So RBI guidelines state that assets, banks advances are classified into standard assets and non-performing assets. So standard assets are those assets accounts which are operating regularly, which are operating satisfactorily, and NPAs are the accounts which cease to generate income for bank. So asset classification is done on the basis of record of recovery. Very important, students, you have to understand that asset classification is done according to the record of recovery. Now say a company is availing cash credit facility of 1 crore. Okay. It has also mortgaged its factory building amounting to rupees 5 crore collaterally with the bank. So bank is fully secured. Okay, besides having primary security of stocks, it is also having collateral security of 5 crore. Say for some reason the account turns NPA in accordance with RBI guidelines. This we'll be discussing after that. What are those guidelines? Assume at this moment that the account turns into NPA. Then RBI guidelines state that these assets have to be classified on the basis of their recovery, not on the basis of what security is available. Say, although the account is fully secured, the bank's exposure is only 1 crore and the security is of valuing of rupees 5 crore. But even then, if the account is not following certain norms, it is flouting those norms which have been prescribed by RBI, then it would be classified as. So RBI guidelines state that asset classification has to be made on the basis of record of recovery, not on the basis of security held or net worth of the say promoters. Clear? So this term is called as asset classification. So when we talk about NPA, students, NPAs are further classified into three types. These are substandard assets, doubtful assets, and loss assets. Substandard, doubtful, loss assets. NPAs, not standard assets. NPAs are further classified into substandard assets, doubtful assets, and loss assets. So what are substandard assets? So substandard assets are those assets which would have certain credit weakness as per the guidelines of RBI, which would have certain credit weakness, which show that the company is under stress, that borrower is under stress, that everything is not well with the company. From the operation of the accounts, the bankers know there are stipulated guidelines. So these assets fall into category of substandard assets. Okay. And doubtful assets are those where stress is greater and it is definite that bank is going to take certain hit in the amount lent, and the borrower is not going to repay all the loan that he has taken. Okay. And what are loss assets? Loss assets are those where there is no hope for recovery. Say either party has fled away, the party has closed the business, or the realizable value of security is well below what was assessed at the time of sanction of the credit facilities. So these are loss assets. Batta khata means ki loss assets hai. Okay. Is that clear, students? Loss assets, doubtful, and substandard assets. So what are the guidelines for substandard assets? Before we understand guidelines of substandard assets, let us understand about income recognition. So RBI guideline states that income in respect of NPAs is to be realized not on accrual basis, but on the basis of actual recovery. Okay, students, you know that, say, when bank lends money, the interest is debited in the account of the borrower in accordance with the terms of sanction. Say the terms of sanction letter requires the interest to be debited monthly. Okay, then automatically system levies the interest monthly. But in case of NPA accounts, when the classification of the account has been changed from standard to a non-performing asset, say substandard asset, a doubtful asset, or loss assets, then interest is not recognized. The moment the asset is classified as NPA, the interest is not recognized on accrual basis. It is only recognized on the basis of actual recovery. If some recovery comes, then it is recognized. Okay. So what is the logic behind it? The logic behind it is that in accordance with the concept of prudence, where the collection of money is in doubt, Okay, then you cannot recognize the same on an accrual basis, because the recovery, there are chances of recovery being in doubt. There are chances of some part of advances being hit, or the bank suffering, bank incurring some loss due to the advance becoming uncollectible. Okay. So this is what we mean by income recognition. Okay, so three things are there. Asset classification. Asset classification means classifying assets in the books of bank as performing or non-performing, and further classification of non-performing into substandard, doubtful, loss assets. Okay, and income recognition means that income in respect of non-performing assets is recognized on the basis of record of recovery, not on accrual basis. Okay, so that income, so as to reflect true picture of the income of the bank. Okay, so as not to artificially inflate the income of the bank, which is not going to be realized. This is the funda, this is the logic behind it. Okay. And what was the third term? Third term was provisioning. Now, what is provisioning? Provisioning is, students, when an asset is recognized as an NPA, as non-performing asset, banks are required to make certain provisions in their books, keeping in view the possibility that recovery of those advances may be hit. Okay, and the bank may suffer loss. So there are RBI guidelines that what amount of what percentage of provision is to be made in respect of, say, substandard assets, in respect of doubtful assets, in respect of loss assets. So there are RBI guidelines in respect of all these. Okay. Yes, Uday, you are saying, can you give example of NP? Yes, Uday, why not? We are here to give you examples. So suppose, Uday, you have taken a car loan of 10 lakhs from a bank. Okay, it is a term loan. You do not pay the installments, 3 monthly installments, and the account becomes overdue because you have not paid 3 monthly installments. The overdue amount is outstanding for more than 90 days. Okay, then after 90 days, your account would become substandard. It would become NPA. The bank would classify in its books your account as an NPA. It would stop charging interest in its books of accounts on an account classified as NPA. It would be keeping a record of that interest charge in a separate memorandum account, but it would not charge interest. It would not credit the interest in its income account. Okay. So you get the example, Uday? So you have understood the meaning of all these three terms: asset classification, income recognition, and provisioning. Asset classification, income recognition, and provisioning. Asset classification means classifying assets as per regulatory norms, as per RBI guidelines, into performing and non-performing, and further classification of non-performing into substandard, doubtful, and loss. Okay. And income recognition means that income in respect of non-performing assets is to be recognized for in respect of NPA accounts only on basis of recovery, not on accrual basis. And provisioning, this I have explained to you right now, that whenever an asset is classified as non-performing, then a certain percentage of outstanding balance in that account, a provision has to be made in the books of accounts of the bank. Now, what is the purpose of this provision? The purpose of this provision is to, again, keeping in view the concept of prudence, that there is a possibility that money would not be paid by the bank, so money would not be repaid by the borrower to the bank. So the bank is making a provision for the expected loss which is to be incurred. Now there are specified percentages which have been prescribed by Reserve Bank of India in this regard. Okay, clear? What do we mean by asset classification, income recognition, and provisioning? Okay, now we come to students, norms of NPA, norms for NPA. Prudential norms, these are known as prudential norms on asset classification. So before we move on to prudential norms on asset classification, you have also to understand, students, that there is a term SMA. What is the full form of this term? This is known as special mention accounts. Now, what are these accounts? So students, you have to understand that this is all part of internal control system of a bank, of classifying account as an special mention account. For the purpose is again credit monitoring. So what are special mention accounts? Special mention accounts are those accounts, number one, these are standard accounts. These are standard assets, standard regular, which are going well, which are doing well, but which are showing some signs of stress. उनमें कुछ गड़बड़ होना स्टार्ट हो गया है. से कोई उस पार्टी का चेक बाउंस हो रहे हैं, या पार्टी जो है जो अपनी इंस्टॉलमेंट है, it is paying the installments, but it is not paying on time. Say installment was required to be paid by say 15th of month every month, but the party is paying sometimes on 20th of that month, sometimes on 25th, sometimes on 1st of that month. Okay, but these have still not fallen into NPA categories. Special mention accounts are not NPA accounts. These are standard accounts, but these have not fallen into NPA. But if not taken care, they can fall. They can fall. So because why? They are showing some signs of stress. So their classification is SMA 0, SMA 1, SMA 2. Now what is SMA 0? SMA 0 means if there are overdues between 0 to 30 days. Say when there are overdues, what do we mean by overdues? Next question. What do we mean by overdues? Overdue, students, means when an amount is not repaid by the borrower to the bank on the due date. Say if I am required to pay my car loan installment on 15th of say June, and I fail to pay it by 15th of June, then on the next day it would become overdue. Okay, so If there are overdues in the account between 0 to 30 days, it is known as SMA 0. If there are overdues in the account between 31 to 60 days, it is known as SMA 1. And when there are overdues in the account between 61 days to 90 days, then it is called SMA 2. So remember, these are standard accounts. These are standard performing regular accounts. So what is the purpose of this classification? So when there is inbuilt criteria in the bank's software, in the bank system, to classify such accounts as special mention accounts, then the bank comes to know, the management comes to know that these accounts are giving signals of stress, that overdues are happening, overdues are occurring, the party is lacking financial discipline. So the bank can follow up with these parties and can take corrective action. So the bank manager would call up that company. Sir, आपकी तो installment पिछली बार भी late आई थी, and this time it is also late by a month. Okay, so there can be a process of follow-up. It alerts the bankers. Okay, so this is the significance of SMA accounts. So you have to remember that SMA accounts are not non-performing assets. These are not NPAs. These are accounts which are showing some signs of stress, but they have not yet been classified as non-performing assets because they still do not meet those norms. अभी उनका डिफॉल्ट, अभी उनका जो ओवरड्यू है वो उतना नहीं है जो कि एनपीए क्लासिफिकेशन के लिए चाहिए. So they are classified as special mention accounts. 3 categories are there: SMA 0, SMA 01, SMA 02. Clear, students? Is it clear? Yes, any doubt about it? Any doubt about it? Yes, about special mention accounts? Anyone? Now we come to Prudential norms on NPAs. Now, what are the Prudential norms on NPAs? So these Prudential norms, students, you have to understand that these norms are based on the nature of advances. On the nature of advances. These norms are based. Yes, Bhumika. They are paying dues but not on time. You can understand that. So Prudential norms on NPAs, these are based on the nature of advances. Say, first, in respect of term loans. Now, a term loan account is classified as NPA if its installment or interest or both. Installment or interest or installment and interest. Okay. These remain overdue for more than 90 days. More than 90 days. So up to, if the overdues are up to 90 days, bank would be classifying internally it as SMA. It has not yet fallen into NPA category. Okay. But once overdue crosses mandatory 90-day period, the term is more than 90 days. Remember, students, period is more than 90 days. Okay. So I have already given example to Uday regarding car loan. So if your overdues in the car loan account are for more than 90 days, then it would be classified as non-performing asset, NPA. And second thing is about bills purchased and discounted. If a bill purchased or discounted by the bank, okay, it is overdue by more than 90 days, overdue for more than 90 days, then it is again classified as NPA. Clear? Now we come to cash credit overdraft accounts. Cash credit overdraft accounts. Now, when does a cash credit account becomes NPA? We have known, we have learned that there are no installments as such in cash credit overdraft account. It is a sort of running account. The party withdraws, then again payment comes, and the borrower uses, and then again credits are coming. So it is a sort of running account. So what are its norms for classifying it as NPA? Prudential norms for classifying it as NPA. So the norms for cash credit overdraft account is that it remains out of order. It remains out of order. Now, what is out of order? It is also defined. It remains out of order. Now, when does a cash credit account remains out of order? When does cash credit account remain out of order? Three conditions are there. If the balance in the account is continuously over the sanction limit or drawing power for 90 days. Okay, say you can understand it this way. Say the cash credit of the account of the company as on 1st January was rupees 1 crore. Say balance is 1.01 crore as on 1st January. Sanction limit is 1 crore. So the account is over, and up till 31st March, okay, the balance in the account has not come below 1 crore. It has not come below 1 crore even for a single day. On all days, the account is running over the sanction limit, or if drawing power is less, over the drawing power. Okay. If this has happened for continuously for 90 days without a break, okay, then the account would be classified as NPA. So this we are talking about cash credit accounts. You understand? Say the company was having a sanction limit of 1 crore. Outstanding balance on 1st January is 1.01 crore. Say the balance doesn't come down even for a single day up to 31st March when the 90 days period is ending, then it would become out of order. and it would be classified as non-performing asset. However, say if the account comes to 95 lakhs or 99 lakhs or 99.9 lakhs on even for a day, this norm would not be applicable. Okay. The word is here is continuously. It should be continuously over the sanction limit or drawing power for 90 days. Okay. And second condition is that although the account is below sanction limit, but there are no credits in the account for 90 days. There are no credits in the account. For 90 days. As on balance sheet date. Okay. So say as on 1st January, the balance was, say, in the CC account was rupees 80 lakhs. But the account has not been operated since then. There are no credits in the account. No single credit has come in the account as on balance sheet date. Then the account would be classified as non-performing asset, CC account. Okay. So any of these three conditions, in the event of any of these three conditions happening, the account would be classified as NPA. CC account would become non-performing asset. And third condition is that although credits are coming, okay, but these are not sufficient to take care of interest. कि जो इसका 3 महीने में ब्याज लगा है, इंटरेस्ट लगा है सीसी अकाउंट पे, वो भी सर्विस नहीं हो रहा, then even then the account would become non-performing asset. Okay, so these are the three conditions for classifying an account, a CC account, as an NPA. In case any of these three conditions is fulfilled, the account would have to be classified as non-performing asset in accordance with potential norms of RBI. Okay. So guys, is that clear? I think today there have been lot of new terms. It is a new topic and lot of new terms have come, lot of new concepts have come. So you might be feeling a little bit more burdensome, but I have tried at my level to explain you the things in very general terms, in a sort of speaking normal conversational language, so that you are able to grasp the things. And because I had thought that if I go by your module, then probably you may not have been able to grasp the things by studying the bookish language, because it needed a sort of practical framework, practical reference. So that is why I have thought it better that it would help you in understanding the concepts in a better way. Okay. So is that fine, guys? So we shall be completing the remaining topics of this chapter, including the balance norms which have been left relating to NPA topic on Tuesday. Okay, so good night to all of you guys. See you on Tuesday. See you on Tuesday, guys. Thank you so much.